Welcome to your presentation for break-even analysis. So what is break-even? What it is, it's the moment in time when you haven't made any money, but you haven't lost any. So really, it's the point where your sales have covered all of your total costs. Anytime after this break-even point, you will start to make profit. Okay? So that's really what the break-even point. So it's any time your sales meet your total costs and you have basically not made any money, but you haven't lost any either. You'll also hear this referred to as the cost volume profit analysis, but we'll refer to it as the break-even analysis. There is some set information that you need before you move forward with a break-even analysis, and that's variable costs and your fixed costs. You'll need to know what they are. Other key definitions, variable cost percentage or VC percentage. It's what percentage of each dollar from sales goes to pay variable expenses. So we should feel comfortable with that from our common size analysis. Contribution margin percentage or CM percentage is what percentage of each dollar from sales goes to fixed expenses and operating profit, okay, or profit volume ratio. Another way to look at that is it's whatever's left over after we've paid for a variable cost percentage. So 1 minus the variable cost percentage would give us our contribution margin percentage. So if you think about it that way, our breakdown of our total revenues, it's really variable cost percentage, and whatever is left is our contribution margin percentage. And that would be to anything that's left over after we've covered our variable cost percentage goes towards our profit and fixed expenses. Okay, so that's the information that we're going to need moving forward. Other key definition, excuse me, BESR. That's what we refer to as break-even sales revenue. How much do I need to bring in money-wise, so sales-wise, to cover fixed and variable expenses with a 0 for operating income? So how much money do I need to make to cover my fixed and variable expenses so that I'm not making any operating income, but I'm also not losing any money? I basically am at 0. I've broken even. I've covered all my costs. Now I start to make money. Break-even units is based on break-even sales revenue and the average product selling price. So how many units must I sell to break even? As far as break-even units go, just realize that it really depends on what you're looking at. In a restaurant, units would be a cover. In a hotel, a unit would be a room sold. Okay, so the reason why we look at our break-even is so that a hotel understands what sales revenues they need to start to make money. Because if they're not going to hit that amount of revenue, there's a very good chance that they'll experience a loss. Okay? So the data needed for us to move forward is our fixed costs and our variable costs. And we should all feel comfortable with the fact that we're going to find this information in our income statements. So there's a few steps in our break-even process. Step 1 is to determine the variable expenses as a percentage of net sales. Okay, so our common size percentage for our total variable expenses. Okay, so it would be our total variable expenses divided by our net sales. So example, if you had $68,000 in variable expenses and $100,000 in revenue, your variable cost percentage would be 68%. So really, for every dollar in sales, 68 cents is going to pay for your variable expenses. That's the way to also read that. In step 2, we have to determine the contribution margin ratio or contribution margin percentage by going 1 minus our VC percentage, or 100% minus variable cost percentage gives us our contribution margin percentage. So using the same example, our contribution margin percentage would be our 100% minus our variable cost percentage, okay, which will give us 32% contribution margin percentage. So again, for every dollar in sales, 32 cents contributes to fixed expenses and to the bottom line, so our operating income. Now once we would have this information, we can start to figure out our break-even sales revenue, or BESR. And we can do that by dividing our fixed costs by our contribution margin percentage. That's going to tell us the revenues that we need to achieve before we can make a profit, but also required to achieve in order to not experience a loss. And that's why we do this math, is to discover, to kind of analyze at what point in revenues are we going to start making money, but also at what point revenues will we have not lost any money. And then break-even units is simply going to be that sales revenue, the revenue we need in sales to break even, divided by an average unit selling price. Okay? So what are the units? An average unit selling price for restaurants would be your average check. Okay? An average unit selling price in hotels would be your average daily rate. Okay? We also have other uses with the break-even sales revenue, and this should start to look a bit familiar. And really, it's because we've covered this with the bottom-up approach to pricing. Okay? We're gonna start to get into a lot of the same calculations. Okay? Operating profit for any sales volume. So it helps determine operating profit for set number of revenues. So if you have a set amount of revenue that you believe that you can get, we can find out the operating profit that we would have based on that revenue. We can also figure out a sales volume needed to reach any required operating profit, and that's the bottom up part, where if you take a look, required operating profit, that's your income before tax plus fixed costs divided by your CM percentage. Well, CM percentage is 1 minus your variable cost percentage. So really, we've been doing this math already with the bottom-up pricing. It's just now we're using our break-even. Okay, so it helps determine break-even sales revenue, break-even units, and occupancy percentage for set operating profit. That's really our bottom-up approach to pricing. But let's go through an example. So your 75-room hotel runs at an average rate of $112.50. Typically, the variable cost percentage is 32%, and the fixed costs are $1.1 million. Okay? So we have our fixed costs, okay? Variable cost percentage. We have it here because it's given, 32%. If it wasn't given, you'd have to divide your variable costs divided by your revenues, if you have that. Okay? Contribution margin percentage. So remember that it's going to be 100% minus whatever your variable cost percents are. So 32%. So whatever is left over. That means for every dollar of revenue that I have, 32 cents of it goes towards variable costs and 68 cents goes towards contribution margin. So that's my fixed expenses and my operating income. So now we can start to discover what our break-even sales revenue is. If you go back to our presentation, to discover that we have to go our fixed costs are $1.1 million divided by my contribution margin. So 0.68, our contribution margin percentage. Okay? And that should tell us that we need to have $1,654,412 in revenue to break even. That means that at that point I will have covered all of my costs, but I will have also not lost any money. Okay, so I'll start to make money, but I'll also have not lost money. So determine the break-even unit. So how many rooms you must sell to break even. So if we go back to the presentation, it's going to be our break-even sales revenue divided by our average unit selling price. In this case, we're talking about a hotel, which has an average rate of $112.50. So we'd go our break-even sales revenue divided by the rate that we're going to sell it by, $112.50. Okay. So we need to sell 14,706 rooms at the $112.50 rate in order to break even. Okay. Great information to have, because now we can start to understand what that means. At what point we're going to start making money, but also at what point we're not losing money. Now, how does your answer in B translate into occupancy percentage? So now we need to find out What does that mean occupancy-wise? What type of occupancy percentage do we need to start making money, to break even, so we can start making money but not lose money? So it would be our 14,706 rooms, okay, divided by, and at this point we would want to divide it by the number of room nights available, because this is break-even units. That means room nights for the whole year. This would be an entire year based on the amount of fixed cost, right? So 14,706 is the break-even units. That's how many room nights we need to sell in order to break even. Well, I need to know what that means in occupancy percentage, so I need to divide my break-even units by my rooms available, room nights available for the whole year. So it'd be 75 times 365. That would give me my room nights available, this part right here, and this would be my room nights that I need to break even. So that means that I need to have a 53.72% occupancy in order to break even. Okay. So now I want to make an operating profit of $50,000. So we need to find out our break-even sales revenue for that amount of money, our break-even units, and our occupancy percentage. So how can we do that? If we go back to bottom up, but also to your presentation, we can find out this new break-even sales revenue based on a set operating profit in a very simple way. We're going to add that operating profit that we want. That's our goal. We're going to add that to our fixed costs, close our brackets, and we're going to divide it by our contribution margin percentage, 0.68. Now, remember, this looks very familiar to our bottom-up approach. We're taking our income before tax goal, okay, plus our fixed costs, and we're dividing it by contribution margin percentage, which is really 1 minus 32%. Okay. We're doing the same thing. So we need to have $1,727,941 in sales in order to make a $50,000 profit. And then we can do the same thing where we can go, okay, $1,727,941 divided by the rate that we're going to have for each room, $112.50. That should tell me how many rooms that represents. So in order to make this revenue, with this rate in mind, I need to sell 15,359 rooms. And then we can start to discover what that means in occupancy. So we can divide that by our 75 rooms times 365 rooms to find out the room nights available. So I need to have a 56% occupancy in order to achieve $50,000 in operating profit. Lastly, we want to figure out an operating profit based on my revenues. Okay? And we can do all of this now that we have this information right here. So we can start by, if you go back to the presentation, to find out an operating profit based on revenues that you believe you can achieve. Okay? So we would have to go our $2 million, multiply that by our contribution margin percentage, so our 0.68. And then from that we're going to subtract our fixed costs. So what this does is $2 million times 0.68. That really takes out the variable costs. It's already finding out what my amount of my revenues, of these $2 million in revenues, what amount will be left over to cover my fixed expenses and then my profit as well, my operating profit. From this answer, we're then simply taking away our fixed expenses to discover what our operating profit will be. And that would be $235,000. So if that was too quick, please go back, review this video, and again, pause it when you need to. Also, please review the break-even handout that's available to you. And that would be how you use break-even sales revenue, break-even units, and contribution margin percentage to find out more information for your hotel or restaurant.